Silver just crashed 33% in a single day, the worst sell-off since the Hunt brothers collapsed in 1980. Gold plunged 12%, its biggest slide in 4 decades. Platinum down $487. Over $1 billion in leveraged positions wiped out in hours. The iShares Silver Trust had its worst day on record. This is the January 30th massacre. And here's what you need to understand. Silver was up 57% in January alone, a 9-month winning streak. Gold had never seen $5,000 per ounce until the day before it crashed. Then it touched $5,595. Thursday, it was a historic high. Friday, it was a bloodbath. The question isn't what happened. The data is clear. The question is whether this is the buying opportunity of a lifetime or the end of the bull market. And when you see what triggered this cascade, when you understand the 4 simultaneous pressure points that converged on January 30th, you'll know exactly what comes next. My name is Alex, and I've spent the last decade tracking commodity cycles and central bank policy so you don't have to. I read Federal Reserve reports and margin requirement filings and technical breakdowns because most people would rather watch paint dry. But this stuff matters. It matters to your portfolio. It matters to your purchasing power. It matters to whether you retire comfortably or work until you're 75. If you want to understand what's really happening in markets while everyone else is panicking or celebrating at exactly the wrong times, make sure to hit that subscribe button and give this video a thumbs up if it helps you see through the noise. Before we dive in, I want to know, what's your silver price prediction by end of year? Drop it in the comments. I'm curious where this audience stands because the range of forecasts right now is absolutely wild. Here's my thesis. January 30th wasn't a collapse. It was a forced liquidation triggered by 4 simultaneous events that created a perfect storm. And understanding the difference between those two things is the difference between buying the dip and catching a falling knife. Let me walk you through what actually happened. Because the headlines tell you prices crashed, they don't tell you why everyone was forced to sell at the same time. January 30th, 2026. The date is going to be remembered. Silver opened above $121 per ounce. By the close, it had plunged to $76. That's a 33% intraday wipeout. Silver futures settled at $78.53, down 31.4%. To put that in perspective, this was the worst single day for silver since March 1980. That was Silver Thursday. The day the Hunt brothers' attempt to corner the silver market collapsed and took the price down 50% in 4 days. Gold wasn't spared. It fell more than 12%, dropping below $5,000 an ounce. The biggest intraday decline since the early 1980s. On Thursday, gold had touched an all-time high of $5,595. 24 hours later, it was at $4,718, a drop of $877 in one session. Platinum dropped $487 from the previous day to $2,298.75. Copper fell 3.4% in London, retreating from Thursday's record high. The metals rout drove down shares of major mining companies. Newmont Corporation, Barrick Mining Corporation, and Agnico Eagle Mines all slid more than 10%. The iShares Silver Trust, the ETF that retail traders pile into, plunged more than 28% in Friday's session, its worst day on record. The people who bought Thursday thinking they were getting in before the next leg up got obliterated. Now here's what matters. This wasn't a gradual sell-off. This wasn't profit-taking spread over days or weeks. This was a simultaneous liquidation event. And that tells you something critical. When prices fall slowly, it's investors changing their minds. When prices fall this fast, it's investors being forced to sell whether they want to or not. So what forced them? 4 triggers, all hitting at once. Trigger 1. Kevin Warsh. President Donald Trump on Friday named Kevin Warsh to succeed Jerome Powell as Federal Reserve Chair. Most people heard that news and thought, okay, new Fed chair, whatever. But the market heard something very different. The market heard hawk. Kevin Warsh served on the Fed's governing board from 2006 to 2011. He was there during the 2008 financial crisis, and while Trump is counting on Warsh to lower interest rates, Warsh's track record suggests the opposite. During his previous term, he frequently warned of inflation that didn't materialize. He was on the hawkish side, while unemployment hovered near 10%. He was the guy arguing for tighter policy when everyone else wanted stimulus. Markets initially traded the Warsh nomination as hawkish. The dollar jumped. Commodity currencies like the Australian dollar and the Swedish krona sold off. And traders started pricing in the possibility of a Federal Reserve that would prioritize fighting inflation over cutting rates. That's a problem for gold and silver. Because the entire rally from late 2025 into January 2026 was built on one narrative: dollar debasement. The idea that the Fed would keep rates low, keep printing money, and keep destroying the purchasing power of the dollar. That narrative made hard assets like gold and silver the obvious place to hide. But if Kevin Warsh becomes Fed chair and he brings the monetary discipline he's known for, that narrative falls apart. Traders regard Warsh as the toughest inflation fighter among the finalists. That raises expectations of monetary policy that would underpin the dollar and weaken greenback price bullion. Now, Powell's term as Fed chair doesn't expire until May 2026. Warsh still faces Senate confirmation, so nothing changes immediately. But markets don't wait for certainty. They price in probabilities. And the probability that the Fed's easy money era is ending just went up significantly. That was trigger one, a narrative shift that undermined the bull case for metals. But a narrative shift alone doesn't cause a 33% crash in silver. For that, you need forced selling, which brings us to trigger 2. Now we get to the part that actually matters. Everything before this was just context. What I'm about to show you next is the mechanism that turned a sell-off into a massacre. Trigger 2. CME margin hikes. The Chicago Mercantile Exchange implemented a series of sharp margin hikes on January 30th. Silver maintenance margins were hiked by 25%, rising to roughly $32,500 per contract. Gold margins saw a 10% increase to $22,000 per contract. If you don't trade futures, let me explain why this matters. When you buy a futures contract, you don't pay the full value up front. You post margin. It's like a good faith deposit. Let's say silver is at $100 per ounce and a contract represents 5,000 ounces. The contract is worth $500,000. But you might only need to post $20,000 in margin to control that position. Here's the problem. When the CME raises margin requirements, anyone holding leveraged positions suddenly needs to post more collateral. If you don't have the cash, you're forced to close the position. If thousands of traders are in the same situation at the same time, they all try to sell at once. Prices collapse. And as prices collapse, more positions hit their stop losses or margin call levels, which forces more selling, which pushes prices lower. It's a liquidation cascade. Over $1 billion in leverage positions were wiped out in a matter of hours on January 30th. These were the weak hands. The traders who were betting big on leverage, riding the momentum, assuming the rally would continue forever. The CME margin hike forced them to either post more collateral or liquidate. Most couldn't post more, so they liquidated, all at once. And then the algorithms kicked in. Algorithmic trading bots are programmed to respond to technical levels. When silver breached key support levels, thousands of contracts were dumped simultaneously by automated systems. It wasn't human decision-making, it was code executing sell orders because the price broke below a threshold. This is almost identical to what happened in 1980. The CME implemented Silver Rule 7 in January 1980, restricting new long positions and hiking margins. The Hunt brothers, who had borrowed billions to corner the silver market, couldn't meet the margin calls. They were forced to liquidate. Silver plunged 50%. That day was called Silver Thursday. January 30th, 2026 just became the new Silver Thursday. So now you have two triggers: a hawkish Fed narrative that undermines the bull case, and a margin hike that forces leverage longs to liquidate. But there's a third trigger, and this one is pure chaos. Trigger 3. The Reuters fake news bomb. On January 30th, Reuters published an exclusive report citing anonymous sources. The claim was that the Trump administration was stepping back from plans to guarantee minimum prices for critical minerals projects. If true, this would be a massive reversal. The administration had been signaling strong support for domestic rare earth and critical mineral production. Guaranteed minimum prices would give mining companies the confidence to invest billions in new projects. The story hit the wires, and algorithmic trading systems immediately dumped positions across the metals complex. Rare earth stocks like USA Rare Earth dropped nearly 9%. Trilogy Metals down 3.3%. MP Materials fell 4.7%. The algorithms don't fact-check, they react to headlines. Here's the problem: the story was false, or at least misleading. The Energy Department issued a statement after the story was published saying the article was false and relies on unnamed sources that are either misinformed or deliberately misleading. Reuters had to rewrite portions of the article after the denial, but the damage was done. By the time the denial came out, the selling had already cascaded through the market. You can't unring that bell. The bots had already executed. The stop losses had already been hit. The margin calls had already gone out. One misleading story, published at the worst possible moment, amplified a crash that was already underway. That's 3 triggers. Warsh, margin hikes, fake news. Any one of those alone might have caused a pullback. All 3 at once caused a wipeout. But there's a fourth factor that made this inevitable. Trigger 4. Extreme overbought conditions and month-end liquidation. Silver was up 57% in January alone. Let me say that again. 57% in 1 month. That's not a bull market. That's a parabolic blow off top. Gold had 7 consecutive up sessions leading into Thursday. Even after Friday's correction, gold was still up 18% in 2026 alone. Gold's RSI, the Relative Strength Index, recently hit 90, the highest it's been for the precious metal in decades. An RSI above 70 is considered overbought. 90 is extreme. It's the market screaming that prices have run too far too fast. Katie Stoves at Mercantile Woods said it best. Just as tech stocks, particularly AI-related names, have dominated market attention and capital flows, gold has similarly seen intense positioning and crowding. When everyone is leaning the same way, even good assets can sell off as positions get unwound. And Friday, January 30th, was the final trading day of the month. Month end is when portfolio managers rebalance, when funds take profits to lock in their January performance numbers, when liquidity thins and price moves get exaggerated. Silver's parabolic rally in January meant massive unrealized gains for anyone who bought in late 2025. Month end was the perfect time to cash out, so you had a market that was already stretched to the breaking point, a Fed narrative shift that undermined the bull case, a margin hike that forced liquidation, a fake news story that triggered algorithmic selling, and month-end profit-taking, all on the same day. That's not a collapse, that's a controlled demolition. If you've made it this far, you're already ahead of 90% of people. But don't stop now, because the next question is the only one that actually matters. Is the bull market over? Or is this the dip you'll regret not buying? Let me show you both sides, because if you only listen to one, you're going to make a very expensive mistake. The bear case. Why this could be the top. Some analysts are calling January 30th a turning point. They're comparing it to the taper tantrum of 2013. Back then, the Federal Reserve signaled it would start tapering its bond buying program. Markets panicked, commodities sold off, and it marked the beginning of a multi-year bear market for gold and silver. The fear now is that the Warsh pivot, the shift from easy money Powell to hawkish Warsh, could trigger the same thing. The argument goes like this. The precious metals rally was built entirely on the expectation of a weak dollar and infinite money printing. If that expectation is wrong, if Warsh brings discipline back to the Fed, then the foundation of the bull case disappears. A strong dollar means weaker commodity prices. Higher real interest rates mean opportunity costs for holding non-yielding assets like gold. And if inflation comes down without a recession, there's no reason to own metals as a hedge. Marko Kolanovic, former chief strategist at JP Morgan, is calling for silver to trade at roughly half its current price later this year. He sees meme traders attempting to take over the market. His view is that the retail crowd piled into silver the same way they piled into GameStop and AMC. And just like those stocks, silver will crash back to reality once the momentum breaks. Then there's the technical damage. Silver broke below key support levels on January 30th, the 50-day exponential moving average, the psychological $100 level. When those levels break, it often signals a trend change. The bulls are now on defense. That's the bear case, and it's not insane. But here's the other side, the bull case. Why the fundamentals haven't changed. The Warsh nomination doesn't change the fact that the federal government has taken ownership stakes in 10 private companies since January. 6 of those 10 are in critical minerals. The Pentagon became the largest shareholder in MP Materials, a rare earth mining company. The Department of Defense has never taken an equity stake in a private company before. That tells you something about how seriously the government is taking supply chain security. China just made it a criminal offense to export rare earth processing technology, not the minerals, the knowledge of how to process them. America has 0 facilities that can do what China just made illegal to teach. That's a supply crisis waiting to happen, and supply crises are bullish for prices. The silver market has been in a supply deficit for 7 consecutive years. The world uses more silver than it mines every single year. That deficit has been filled by above-ground stockpiles and recycling. But those stockpiles are shrinking. Industrial demand, particularly from solar panels and electric vehicles, is hitting record levels. Solar panel production alone is projected to consume over 200 million ounces of silver annually by 2030. There is no substitute for silver in most industrial applications. You need it for conductivity. You need it for solar cells. You need it for electronics. So even if investment demand drops because of a hawkish Fed, industrial demand isn't going anywhere. And industrial demand doesn't care about interest rates. It cares about supply. Here's the other thing. Central banks are still buying gold. They've been net buyers for 14 consecutive quarters. Russia, China, India, Turkey. They're diversifying away from the dollar. That didn't stop on January 30th. Geopolitical fragmentation didn't stop. The de-dollarization trend didn't stop. Those are long-term structural drivers. A one-day crash doesn't change that. And from a technical perspective, silver found support right at the 50-day exponential moving average near 70.81. That level coincides with late 2025 peaks. It's a logical place for buyers to step in. If silver holds above $70, the worst is likely over. If it breaks below, then we have a problem. But as of right now, it's holding. Even after Friday's crash, gold is still up approximately 80% over 12 months. Silver is still up massively from $29 in early 2025. We're not back at the lows. We're just off the highs. And then there are the institutional price targets. Yardeni Research has a $6,000 per ounce gold target for 2026. Deutsche Bank raised their forecast to $6,000. JP Morgan is calling for $5,055 by Q4 2026 with potential peaks at $5,200 to $5,300. Goldman Sachs has a $4,900 per ounce forecast. Bank of America says $5,000. Morgan Stanley says $4,800 by Q4. These aren't fringe analysts. These are the biggest banks in the world. And their targets are all above where gold is trading right now. They're not saying the bull market is over. They're saying Friday was noise. So here's what it comes down to. Do you believe the Warsh Fed will aggressively tighten policy and kill the metals rally? Or do you believe the fundamental supply deficit and geopolitical drivers are stronger than short-term policy uncertainty? I can't answer that for you. But I can tell you what the levels are. What you need to watch to know which scenario is playing out. For silver, the key support is 70.81. That's the 50-day exponential moving average. If silver holds above that level and closes above $80 in the next few sessions, it suggests buyers are stepping in and the worst is over. If it breaks below 70, the next major support is at $55. That's the 200-day exponential moving average. That's the ultimate line in the sand for bulls. If 55 breaks, the bull market is in serious trouble. For gold, the key support is $5,000. Psychological levels matter. If gold holds 5,000, confidence remains intact. Below that, the next support zone is 4,550, which aligns with late 2025 highs and the 50-day moving average, extending down to 4,360. If that zone breaks, we're looking at a retest of 4,000. On the upside, resistance for gold is 5,400 to 5,450. That's where Thursday's all-time high was rejected. If gold reclaims that level, it signals the crash was just a shakeout and the rally resumes. For silver, resistance is at $100. If silver gets back above 100, the breakout remains intact. Until then, it's in no man's land. Now let me tie all of this together, because when you see how these pieces connect, everything changes. January 30th wasn't random. It was a liquidation event triggered by 4 simultaneous pressure points, a narrative shift with the Warsh nomination, a margin hike that forced weak hands out, a misleading news story that triggered algorithmic selling, and extreme overbought conditions on month end. Any one of those could have caused a pullback. All 4 at once caused a massacre. But here's what matters. None of those triggers changed the underlying fundamentals. The supply deficit in silver is still real. Central bank buying is still happening. Geopolitical fragmentation is still accelerating. Industrial demand is still growing. The infrastructure spending and green energy transition that requires massive amounts of copper, silver, lithium, and rare earths is still happening. What changed on January 30th was sentiment, and sentiment is temporary. Fundamentals are not. The people who got wiped out on January 30th were the leveraged traders, the momentum chasers, the people who bought at 120 because they thought it was going to 150 by next week. Those people are gone now. The weak hands got shaken out. That's actually healthy for the market. It resets the trade, it clears the excess speculation, it creates room for the next leg. If you're a physical holder, someone who bought silver at $30 or gold at 2000, January 30th changed nothing. You're still up massively. Your thesis was never about short-term price action. It was about long-term wealth preservation and protection against currency debasement. That thesis is intact. If you're a leverage trader, January 30th was a brutal reminder that volatility works both ways. Leverage amplifies gains. It also amplifies losses. And when margin calls go out, it doesn't matter what your thesis is. You're forced to sell. The key takeaway is this: Fed leadership matters. The nomination of Kevin Warsh has fundamentally altered the dollar debasement narrative, at least in the short term. But Powell's term runs until May. Markets have months to digest what a Warsh Fed will actually look like, and by the time Warsh takes over, if he takes over, the market will have already priced it in. Leverage hurts. The 33% silver crash highlights the danger of crowded trades and parabolic moves. When everyone is positioned the same way, when margin calls go out, prices don't care about your long-term thesis. They care about liquidity, and liquidity disappears fast. But fundamentals are unchanged. Supply deficits, central bank buying, geopolitical tensions, industrial demand, none of that stopped on January 30th. And those are the factors that will determine where prices are in 6 months, in 12 months, in 5 years. For physical holders, this changes nothing about the long-term thesis. You're not trading, you're protecting wealth. Short-term volatility is irrelevant. For traders, watch the levels. Silver above 70.81 and gold above 5,000 means the bull market is intact. Below those levels, we have a problem. And for everyone, understand this. January 30th was forced liquidation, not organic selling. The difference matters. Forced liquidation creates opportunity. Organic selling creates bear markets. Know which one you're looking at. Silver, gold, central bank policy, inflation. What's the next topic you want me to dig into? Drop it in the comments. If there's a financial story that's keeping you up at night that nobody's explaining properly, tell me. That's what this channel is for. Your future self is counting on you to see through the noise, to understand the difference between a liquidation event and a collapse, to know when fear is justified and when it's just leverage unwinding. January 30th was chaos, but chaos creates opportunity. The question is whether you're positioned to take it, or whether you're still trying to figure out what just happened.